A job pays you when you work. An asset pays you when you don't. That is the entire game of wealth, compressed into 2 sentences. The strategy is simple. Take the active income you earn by trading your hours and convert it into assets that generate cash flow whether you're working, sleeping, or on vacation. There are exactly 12 categories of assets generating passive income, ranked from zero effort to genuinely hands-on. Most people can only name 2 or 3. We are covering the full list today, ending with a rarely discussed vehicle that relies on an asset class most investors ignore. The numbers attached to that final asset suggest a much higher ceiling for passive returns than the traditional options we usually consider. We're looking at real entry costs, real expected returns, and the specific time investment required for each one. We'll start with the easiest possible entry points and build toward the ones requiring significant capital or skill. You'll see quickly that passive income requires a calculated exchange. You are deploying upfront resources, either your time or capital, to secure delayed financial freedom. Asset 1 is a high-yield savings account. The entry cost is 0, the skill required is 0, and it carries essentially no risk to your principal because it's backed by FDIC insurance. This chart shows the mechanic in action. If you let $10,000 sit in a standard checking account, it earns close to nothing. Moving that same $10,000 into a high-yield account at 4.5% generates a $450 yield with 0 effort. However, inflation regularly matches or exceeds these returns. Use this as a floor, a place for emergency funds to earn a small yield rather than sitting dead in a checking account. To actually build wealth, we move to Asset 2, index funds. Most brokerages have 0 minimum capital requirements, and the skill needed to start is minimal. This graph maps out the long-term compound math based on historical returns of 8% to 10%. If you invest $500 a month consistently at a 9% return, the math curves upward until it crosses $1 million in roughly 33 years. You achieve those numbers by ignoring individual stocks. Instead, you're betting on the aggregate growth of the entire economy over time. Once automated, this asset genuinely runs itself. Assets 1 and 2 prioritize 0 daily effort. They demand capital and extreme patience, as you are sacrificing immediate cash flow for long-term growth. For regular, liquid cash payments right now, we look at Asset 3, dividend stocks. With dividend stocks, you are paid in cash simply for holding shares in a profitable company. You typically see 3% to 6% in dividend yield alone, separate from any capital appreciation the stock delivers. The trade-off is concentration risk. If you pick the wrong individual companies, you are exposed to a single failure that can wipe out your principal and stop your income stream entirely. To mitigate that risk while maintaining cash flow, you can use Asset 4, real estate investment trusts, or REITs. These allow you to own income-producing real estate for the price of a single share, often under $100. This visual highlights the legal mechanism involved. REITs are companies that own properties like apartment buildings or warehouses, and they are required by law to distribute at least 90% of their taxable income back to shareholders. You get real estate cash flow without the operational headaches of being a landlord. You trade the higher potential upside of direct ownership for a completely passive structure. Assets 3 and 4 provide immediate cash flow, but they introduce targeted market risks and demand moderate research to execute safely. Asset 5 is rental property. This is a high-capital, high-friction path that generates cash-on-cash returns commonly in the 8% to 15% range. This flow equation shows how leverage impacts your returns. A $250,000 property purchased with a $50,000 down payment that generates $500 a month in net cash flow produces a 12% cash-on-cash return. Even with a property manager, this is the least passive asset we've covered. It requires significant initial skill in selection and financing, plus active exposure to vacancy risks. Asset 6 is digital products. This flips the requirements, calling for near-zero financial capital. Instead, your investment is the time and skill needed to build an online video course, a digital template, or a software product. This multiplier equation highlights the efficiency of the model. With no physical inventory or shipping, you operate at 90% margins or higher. A simple $30 digital guide only needs 34 sales a month to generate $1,000. You build it once, and it can generate revenue indefinitely. Each new sale happens with zero marginal cost and no additional labor once the product exists. Assets 5 and 6 provide high yields and control, but they demand either significant capital risk or heavy upfront sweat equity to get off the ground. Looking back at these first 6 examples, passive describes a specific trade-off. You concentrate the effort strictly at the start, allowing the income to continue independent of your daily labor. This quadrant chart measures the 2 variables that determine where to start: how easy the asset is to cash out, liquidity, against how hard it is to manage, effort. High-yield savings and index funds sit at the top. They offer maximum liquidity and require almost zero daily management once they are set up. Dividend stocks and REITs are also highly liquid, but they land in the moderate effort zone because they require more upfront research. Rental properties sit at the bottom of liquidity and the maximum end of effort, making them a fit for capital-rich investors willing to trade convenience for higher returns. Digital products are a unique outlier. They require high effort and offer low liquidity, but they are the only asset here that functions with nearly zero ongoing capital.
Asset 7. Content platforms. Entry cost is near zero. A camera, a microphone, or a laptop, and a willingness to write. Most people assume content platforms, like YouTube channels and newsletters, are highly passive. In reality, the first year is almost pure labor for very little return. You are pushing a boulder uphill, but eventually the math flips. Once an audience and a content library exist, older content keeps generating views and revenue indefinitely. A video posted 3 years ago can still earn daily ad revenue today, with zero additional effort required for that specific piece of work. Asset 8 takes this a step further. Royalties are the purest expression of the build once, earn indefinitely philosophy on this entire list. The structure is highly specific. You create a song, write a book, or file a patent one time. You then earn a percentage of the revenue every single time someone else uses, streams, sells, or licenses it, frequently for decades afterward. Asset 9 is a micro-business hiding in plain sight: vending machines and ATMs. Most people walk past hundreds of these without considering them an investment category. These machines have real, calculable unit economics. A few hundred to a few $1,000s secures the hardware. From there, a machine in a high-traffic location generates consistent monthly cash flow with a modest weekly maintenance routine. Because the logistics are simple, one machine easily scales to 20. These 3 assets require either intense upfront creative labor or basic physical logistics to get started, but they successfully execute the main objective: decoupling your time from your ongoing revenue. Asset 10 is peer-to-peer lending. Instead of a bank sitting between a borrower and a lender, digital platforms connect you directly to individuals needing capital. You provide the loan, and you earn the 5% to 8% interest margin that would normally go to the bank. The realistic danger here must be stated plainly. Individual loans can and do default. To manage this, responsible lenders use micro-diversification. By spreading capital across hundreds of tiny loans rather than concentrating it in a few large ones, a single default barely dents the overall returns of the pool. Asset 11 demands the highest initial skill on this list: business equity. A business that requires your daily presence to function is not a passive asset. It is simply a job with extra steps. A true asset runs on documented systems and a trained team, generating income whether the owner is in the building or not. Whether you are lending capital or building a company, creating passive income at this tier requires aggressive risk management and intentionally removing yourself as the operational bottleneck. Asset 12 is Farmland. It almost never makes traditional financial lists, yet it serves as one of the most effective portfolio diversifiers available. This chart shows the NC REIF Farmland Index over a multi-decade period. When you combine land appreciation and rental income, direct farmland investment has delivered average annual returns of approximately 11% to 13%, frequently outperforming traditional dividend stocks and standard real estate trusts. Now look at what happens to this chart when traditional equities drop. Farmland historically shows a notably low correlation with stocks and bonds. When the stock market declines, farmland values frequently hold steady, smoothing out overall portfolio volatility.
This graph also demonstrates its function as a strong inflation hedge. There is roughly a 70% historical correlation between U.S. farmland values and the consumer price index. As the cost of goods rises, farmland values tend to rise right alongside them. The massive hurdle most people assume exists here is that you have to actually buy acreage and manage a farming operation. You do not. Publicly traded farmland real estate investment trusts handle leasing the land to professional farmers and passing the rent back to shareholders. You can buy a single share through a normal brokerage account, exactly the same way you buy a standard stock. Because it offers historical outperformance and protects real purchasing power without requiring specialized agricultural knowledge, Farmland is a uniquely powerful financial tool. We have now outlined all 12 assets. Attempting to build all 12 at once is a guaranteed path to burnout. You only need 2 or 3. To find them, filter this list through your current constraints, your available capital, your time, and your specific skill sets. If your capital and free time are severely limited, start strictly with assets 1 and 2, a high-yield savings account and an index fund. They require the lowest baseline of both. If you possess a specific skill worth packaging, route your focus directly to asset 6 and build a digital product. If you want to own something tangible with strong historical diversification benefits, begin researching asset 12, the Farmland REITs. Brutal self-awareness regarding what you can realistically commit to is the only reliable way to select the correct vehicle. Here's the final instruction for this masterclass. Pick exactly one asset that matches your reality today. Instead of getting stuck in analysis paralysis, define one concrete, friction-free step toward that asset and execute it this week. Open the savings account. Read the prospectus for the REIT. Draft the digital product outline. If the historical data behind the farmland asset genuinely surprised you, subscribe for more breakdowns. Theoretical knowledge of passive income is entirely worthless until you tie it to a single concrete point of execution. Take your first step today.